So, uh, what if I told you that the sudden, massive wave of layoffs we're seeing sweep through Silicon Valley and the U.S. national debt hurling toward $40 trillion are actually the exact same story?
I mean, on the surface, yeah, that sounds like a total conspiracy theory. But well, when you actually look at the systemic models forecasting the next few years, the math around global liquidity draws a straight, undeniable line between the two.
Right. And that is the paradox we're unpacking today. Welcome to the deep dive. Our mission today is to look at a massive number, the projected $40 trillion U.S. national debt by late August 2026, and understand it, not just as a budget issue. We want to view it as a systemic perturbation.
Exactly. We're looking at a financial shockwave that alters everything from global banking architecture to why billionaire tech CEOs are suddenly reading from the exact same script.
Yeah, and we have a really fascinating stack of sources today. We've got raw data from the Joint Economic Committee, Pew Research, Morningstar, and some highly complex forecast registrations uploaded to Zenodo. Those are by a systems theorist named Jericho DeVita.
But, before we get into the plumbing of the global economy, it's crucial that we establish the framework of this analysis for you listening right now. Our sources naturally include a heavy amount of, well, politically charged data.
Very much so.
Right. They track the specific financial decisions made during the Trump, Biden, Obama, and Bush administrations. And the models also factor in highly volatile political scenarios like government shutdowns, the 2026 midterm elections, and even potential impeachment shocks.
Yeah, so we want to be incredibly clear up front about this. We are looking at this purely as analysts. We aren't picking sides, and we absolutely do not endorse any political ideology or party.
Not at all.
Our only goal here is to lay out the data and the mechanics from these original sources, just so you can see the landscape clearly.
And honestly, taking the politics out of the equation is essential for understanding systems theory anyway. I mean, in the advanced models we'll be examining, a political event is simply treated as another variable.
Right, just a data point.
Exactly. It's a stressor applied to a physical structure. We are entirely focused on how the structure holds up, not, the political motivations of whoever applied the stress.
So let's actually look at that structure. According to the Joint Economic Committee's debt dashboard, as of August 2026, the total gross national debt is hovering right at $39.94 trillion.
Which is just a massive number to wrap your head around.
It is. And at the current pace, it's projected to cross the 40 trillion threshold around August 31st. But, the raw number doesn't really capture the sheer velocity of what's happening.
No, it doesn't.
Over the past year, the debt has grown by roughly $91,305 every single second.
Yeah, to put the physics of that into perspective, while you take a single breath, the national debt increases by more than the median annual salary of an American worker. Right. When you do the math out, it equates to adding almost $7.88 billion to the national ledger every single day.
I mean, if you try to map that onto your own life, it just fundamentally breaks your brain. Like, imagine logging into your bank app and your credit card balance is growing by 91 grand a second.
You'd panic.
You would. At a certain point, the math guarantees system failure because you physically cannot out-earn the principal. So how did the foundation get so heavy?
I'm looking at the historical data from Investopedia here, and the story really shifts depending on whether you measure the debt in percentages or raw dollars.
Yeah, it does. So the record for the largest percentage increase to the national debt still belongs to Franklin D. Roosevelt.
Right, the New Deal.
Exactly. The combination of funding the New Deal to combat the Great Depression, followed immediately by the massive industrial mobilization for World War II, required the U.S. to borrow roughly $211 billion.
Which doesn't sound like much now, but back then...
Right. Relative to the very small size of the economy back then, that was a staggering expansion of the debt-to-GDP ratio. But when we look at the raw trillions, the absolute mass of the debt we are dealing with today, that is a distinctly modern phenomenon. Looking at the visual data breakdown of the composition of the debt, there's a very clear, very steep inflection point.
A huge spike.
Yeah. Essentially, almost half of this 40 trillion, 49.31% to be exact, was added by just 2 presidents over an incredibly condensed window.
Yeah, the acceleration really kicks into overdrive starting in late 2017. Donald Trump's first term, which spanned fiscal years 2018 to 2021, added roughly $8.18 trillion.
Okay.
Then Joe Biden's term followed that with an addition of $9.21 trillion. And now, moving into Trump's Second term, starting in fiscal year 2026, we've already seen another 2.30 trillion piled on.
So wait, nearly $19.7 trillion was generated in under a decade, while the remaining $20.24 trillion took the entire history of the country prior to October 2017 to accumulate.
Exactly. And the sources provide important historical context for that momentum. I mean, this acceleration isn't happening in a vacuum. It is the literal cost of continuous crisis management. George W. Bush added about $4 trillion fighting the war on terror and managing the initial fallout of the 2008 financial crisis. Then Barack Obama added over $8 trillion with the American Recovery and Reinvestment Act, to pull the economy out of that severe recession, while also extending Bush-era tax cuts.
And then COVID hit.
Right. And of course, the Trump and Biden administrations oversaw multi-trillion-dollar COVID-19 stimulus packages, the CARES Act, the American Rescue Plan. When the system faces an existential crisis, the government essentially buys its way out to prevent an immediate depression.
But, buying your way out of a crisis has a delayed structural cost. The debt doesn't just sit there frozen in time on a spreadsheet. You actually have to maintain it.
Yeah, you have to pay the interest.
Exactly. You have to pay interest to the bondholders. And this is where I want to transition from simply marveling at this massive number to understanding the actual physical strain it puts on the plumbing of the economy.
Well, the carrying cost is the true metric of systemic strain. If we connect this to the broader budget, using the Pew Research data from just 2 years ago, fiscal year 2024, the net interest on the debt was already at $879.9 billion.
Which, as the data points out, was already more than we were spending on Medicare or national defense. I mean, we were spending more money simply to service past borrowing than to secure the country or provide health care for seniors.
Yeah, and the mathematical reality has escalated dramatically since then. The Morningstar data cites Michael Hartnett. He's the chief equity strategist at Bank of America.
Okay, what does he say?
His calculations for 2026 show the yearly interest costs hitting $1.5 trillion. The average interest rate on total marketable debt has climbed to almost 3.45%.
Wow.
Yeah, when the Federal Reserve raised rates to fight inflation back in 2022, they fundamentally changed the math on sovereign borrowing.
Let's pause and unpack the mechanics of that because it feels incredibly important for you listening to really grasp. Historically, U.S. Treasuries, government bonds are considered the ultimate safe haven.
The safest bet there is, historically.
Right. They are the risk-free rate that all other global investments are measured against. But with interest eating up nearly 14% of the entire federal budget, Hartnett is talking about an anything but bonds era. I need you to explain why investors are suddenly running away from the safest asset on earth.
It comes down to the mechanics of how a sovereign nation resolves an unpayable debt. When a government owes $40 trillion, and Hartnett projects that figure could hit $50 trillion by mid-2029.
50 trillion.
Yeah, 50. Institutional investors realize the government can't simply raise taxes or cut spending enough to pay off the principal. I mean, the political will for that level of austerity just doesn't exist. So the government has to shrink the relative size of the debt compared to the economy.
By inflating the economy.
Yeah.
By cheapening the currency. So the debt is technically the same number on paper, but the actual dollars used to pay it are worth significantly less.
Exactly. That mechanism is known as dollar debasement. Policymakers are essentially forced to engineer explosive nominal GDP growth. They need the overall size of the economy, measured in newly inflated dollars, to skyrocket so the debt-to-GDP ratio looks manageable to foreign creditors.
So if you are an investor holding a 10-year Treasury bond with a fixed 4% return, inflation is actively destroying your wealth.
Right. Your fixed payout buys fewer goods every single year.
So the bond market becomes a trap. And that totally explains the capital flight. If bonds are guaranteed to lose their purchasing power, you have to pull your money out and put it somewhere else.
Precisely. Which is why the data shows capital flooding into equities, the stock market, as well as gold and emerging markets.
Oh, that makes sense.
Yeah, the stock market becomes a necessary refuge rather than a speculative bet. Investors start treating major equities as, too big to fail because they believe the government has no choice but to keep the monetary plumbing loose to manage the massive debt burden.
Okay, so the bond market's failure as a safe haven acts as a high-pressure pump, forcing capital into the private stock market. Keep that mechanical image in your mind as we turn to the most complex part of our stack today. The Zenodo uploads by Jericho Devia.
These are fascinating.
They really are. These documents center on something called the Bridge 360 Metatheory model.
Yeah, the Bridge 360 model functions as a truth-neutral governance algorithm. It is an advanced diagnostic tool for the global operating system.
Right.
It doesn't look at the economy as isolated parts, but as a deeply interconnected web where a strain in one area mathematically forces a reaction in another. And the documents we're analyzing here are forecast registration.
Now, forecast registration, meaning the author is putting their predictions out in public now, specifically analyzing the window of the fourth quarter of 2026 through the first quarter of 2027 to establish a verifiable track record for their model.
They are calling their shots.
Right.
And they treat this $40 trillion debt environment not just as a background detail, but as a massive systemic perturbation. Yeah. A perturbation in systems theory is a severe distortion in a system's baseline state.
Let me try a plumbing analogy here for the listener.
Yeah.
Imagine a massive network of pressurized water pipes. That's the global financial system. The $40 trillion debt is a massive blockage in the main line.
Okay, I like this.
The capital has to go somewhere, so it's forced into smaller auxiliary pipes, putting immense, unprecedented pressure on them. The debt is the underlying fragility. But what the Zenodo model is looking for are the external blows, the sledgehammers hitting those already overpressurized pipes. That could cause a complete rupture.
Exactly. And the model identifies several of those potential sledgehammers converging in late 2026. One major factor is the Federal Reserve leadership transition in May 2026, as Jerome Powell hands the reins to Kevin Warsh.
I can see why that's a trigger. If you have an environment where the interest payment alone is $1.5 trillion, the market needs absolute certainty that the Fed is independent and managing the currency effectively. Any transition creates doubt.
Right. Then add the volatility of the 2026 midterm elections acting as a discrete phase transition. The model also calculates the friction of fiscal brinkmanship, specifically the very real threat of a government shutdown.
Which we see all the time now.
We do. And it even factors in the systemic shock of potential impeachment proceedings. All of these political stressors disrupt the smooth transmission of monetary policy, making the debt harder to finance.
Okay, so those make sense as macroeconomic and political pressure points. But this is where the Zenodo model completely caught me off guard. It takes all of this macroeconomic debt theory and connects it directly to Silicon Valley.
Yes.
Specifically to what they call the unison of big tech CEOs regarding artificial intelligence.
Yeah, the Bridge 360 model points out that the leadership of the tech industry are behaving in a highly coordinated, almost identical manner. They are operating on a completely unified narrative about the inevitability of the scale phase of agentic AI.
Let me push back on this on behalf of the listener because, frankly, I struggle to believe that a $500 billion technological revolution is just a smokescreen.
A fair question.
Right. I mean, isn't it far more likely that agentic AI that can actually execute complex workflows independently rather than just generating text is simply the next genuine leap, like the internet or the smartphone? They're all talking about it because the tech is finally ready to change the world. Why does the model assume this is a macroeconomic signal rather than just technological progress?
Well, the model looks beyond the public relations narrative and examines the underlying financial flows, identifying what it terms a volatility paradox.
A volatility paradox.
Yeah, a volatility paradox happens when a system displays absolute surface stability and consensus, but that uniformity is actually a defensive mechanism designed to mask severe structural fragility underneath.
So the fact that they all agree is the red flag.
Exactly. The behavior contradicts the narrative. Big tech companies are collectively justifying over $500 billion in capital expenditures this year to build AI infrastructure.
Massive server farms. GPUs.
Right, incredible power and cooling demands. Yet, simultaneously, these very same companies are conducting aggressive, widespread layoffs of their highly skilled tech workforces.
Which mathematically doesn't track. If you are entering the greatest growth phase in human history, one that requires $500 billion of immediate investment, you don't fire your builders.
No, you don't. The AI narrative serves as a bridge. It is a necessary fiction to reassure Wall Street. Underneath the surface, there is profound structural credit stress.
Okay, how so?
Because the massive sovereign debt is sucking up so much capital and forcing baseline interest rates higher, the private credit markets, the places where companies usually go to borrow money for expansion, are incredibly constrained and fragile.
Oh man, I see the plumbing now. Because the government is borrowing so aggressively to fund its $40 trillion debt, it crowds out private companies.
Precisely.
The tech giants can't borrow cheaply in the credit markets anymore. So they must rely on their stock valuations to fund this massive infrastructure build and to keep the stock price high, to keep that equity capital flowing from those anything but bonds investors we talked about earlier, they have to project absolute unified certainty that AI is going to generate infinite future profits.
You nailed it. The unison reduces the perceived risk for investors. If every CEO says the exact same thing, the market feels safe pouring money into their stocks.
Right.
But the layoffs are the empirical tell. They reveal the underlying need to ruthlessly cut operational costs to survive a very real liquidity crunch. The consensus isn't proof of technological readiness. It's a symptom of financial fragility caused by the debt environment.
That is a brilliant and honestly slightly terrifying reframing of the tech industry. It means the AI arms race is partially a defensive maneuver against the gravitational pull of the national debt. So if this whole structure is built on a narrative bridge over a liquidity sinkhole, how do we know if the bridge is collapsing? The Zenodo documents don't just offer theories, they offer specific metrics, right?
Yeah, they do. They point to Japan as the crucial early warning platform. The model designates Japan as the transmission node for a global rebalancing.
I'm looking at the Pew data here, and I see why. Japan is uniquely positioned because they are the largest foreign holder of U.S. debt.
That's right.
They hold over $1.1 trillion in U.S. treasuries. They essentially hold the mortgage on this whole system. If the bond market starts to crack, Japan feels the tremor first.
Yeah, their financial system is highly leveraged to U.S. debt and currency stability. The Zenodo model details a set of threshold metrics in Japan called Tripwire 6, or caveat hiding alerts.
Tripwire 6.
The model states that a systemic break will occur if 3 specific metrics breach their threshold simultaneously, likely catalyzed by external shocks like the ongoing 2026 Iran war or the emergence of multi-rail finance.
I want to make sure we define that real quick. Multi-rail finance, meaning a shift where groups of countries like the BRICS nations begin bypassing the U.S. dollar and setting up alternative payment systems, settling trade in local currencies, which further weakens global demand for our debt.
Got it. So what are the 3 metrics we're looking for in Tripwire 6?
So the first is an energy shock, Brent crude oil, sustaining a price over $120 a barrel. The second is a financial panic indicator bank. Credit default swap spreads widening beyond 50 basis points.
Let me clarify that for a second to make sure I understand the mechanism. A credit default swap is essentially an insurance policy against a company, in this case, a major bank going bankrupt.
Right.
The spread is the premium you pay. So if that spread widens past 50 basis points, it means the market is suddenly demanding a lot more money to insure against bank failures because they believe the risk of a collapse just spiked.
Exactly. The spread acts as a real-time fear gauge for institutional liquidity.
Okay, and the third metric? The third metric is the collapse of the tech narrative AI infrastructure write-downs exceeding $10 billion.
Wow.
This means companies are mathematically forced to admit on their balance sheets that their server farms and AI investments aren't actually generating the revenue they promised, and the assets are functionally worthless.
I see how these 3 interact to create a rupture. An oil spike over $120 hammers the broader economy and drives up inflation, forcing the Fed's hand.
Right.
The widening CDS spreads mean the banks are facing a severe liquidity crisis and will stop lending entirely. And the $10 billion AI write-down shatters that narrative bridge the tech CEOs built, instantly crashing the equity markets. It's a localized failure that immediately goes global.
If those 3 events coincide, the model dictates an immediate regime shift in strategic governance is required. The surface stability officially cracks, and the volatility paradox resolves into actual volatility.
And looking at the forecast registration for Q1 2027, what are the actual scenarios if this plays out? What is the model predicting for the economy?
The documents lay out 2 distinct economic paths. The baseline expectation is a scenario called brittle growth.
Brittle growth.
Yeah, the system manages to absorb the perturbations without a total rupture. The U.S. economy manages a GDP growth rate of roughly 2.2 to 2.5%. However, it's categorized by extreme volatility and the constant lingering threat of severe policy tightening.
Brittle being the operative word there. The structure looks intact, but you don't want to tap on the glass too hard?
Exactly. The alternative path is the vortex scenario, also termed systemic decoupling.
That sounds bad.
It is. This triggers if those highly disruptive perturbations, the bond market flight, the government shutdowns, the energy shocks, all compound on one another and trip the thresholds. In the Vitex scenario, the U.S. faces a Q1 2027 GDP contraction of negative 0.5 to 0.2%.
A real contraction.
Yeah, it brings severe unemployment pressure and fundamentally challenges the confidence in the U.S. dollar as the global reserve currency.
Which loops us entirely back to the beginning of our deep dive. The failure of the dollar validates Michael Hartnett's warning about debasement, driving investors even further into gold and creating a vicious, inescapable downward spiral for the $40 trillion debt.
Yeah.
The gravity well just keeps pulling.
The $40 trillion debt is the gravity well. Every other variable, Federal Reserve policy, tech narratives, Japanese bond yields, is just orbiting around it, getting stretched and warped by its massive pull.
We have covered an immense amount of ground today, and I think the biggest takeaway is how entirely interconnected the modern financial system is.
Unbelievably interconnected.
When you hear that the U.S. national debt is crossing $40 trillion, it is so easy to dismiss it as just a political talking point or, a distant number on a treasury spreadsheet that doesn't really affect your day-to-day life.
But the models show us that it is the invisible architecture dictating market behavior. It dictates the cost of your capital. It forces your retirement funds into the stock market seeking safety from inflation. And it creates the liquidity vacuums that force the world's most powerful companies to mask their fragility behind unified PR campaigns.
It really changes the way you process the news. The next time you see a headline about a massive tech layoff buried underneath an announcement for a new billion-dollar AI data center, you'll know you aren't just looking at a corporate strategy pivot.
No, you're not.
You might be looking at the ripple effect of a $40 trillion sovereign debt burden.
When you understand the underlying mechanisms, the why and the how, the daily noise of the market starts to look a lot more like a readable blueprint.
Which leaves me with one final thought for you to mull over today. We spent a lot of time breaking down the Zenodo model's concept of the volatility paradox. This idea that absolute consensus and apparent stability actually mask deep structural fragility. We see it in Silicon Valley, where billionaire CEOs moving in total lockstep is actually a red flag for systemic financial stress. But pull that concept out of macroeconomics and apply it closer to home. If total unison at the top of the market is actually a sign of extreme danger, where else in your own life, your career, or your personal investments are you looking at total agreement, with everyone singing from the exact same hymnal and mistakenly assuming that consensus means you're safe?